In a market that usually drifts in slow, heavy currents, silver just moved like a snapped cable. In less than 48 hours, price action went from routine to rupture, with reports of a plunge as large as 15% in a single session before stabilizing. That kind of move doesn't belong to a metal that sits quietly inside smartphones, solar panels, medical devices, and factory inventories. It belongs to a market where leverage is stressed, liquidity is thinning, and somebody is being forced to make a decision they did not plan to make. And here's what should stop you cold. During a violent sell-off, the common assumption is that scarcity fears vanish. If something is truly tight, people think price would rise, not collapse. But silver has a strange habit of doing the opposite at the exact moment the risk becomes real. The screen price can fall because paper positions are being liquidated, while the underlying mechanics can tighten because physical demand refuses to step away. The crash becomes camouflage. They said this could never happen in a modern, electronically traded precious metals market. Not with clearinghouses, not with deep derivatives, not with large bullion banks acting as shock absorbers. The story is that any shortage can be neutralized by rolling a contract forward, by swapping exposure, by sourcing metal somewhere, and by settling in cash, if needed. But markets don't care about stories. They care about settlement. Institutions already know this. They don't watch the same scoreboard. While most people debate charts and headlines, the largest players watch one signal that tends to move first when the risk of a short squeeze rises. It's not a rumor, and it's not a meme. It's a measurable distortion in the very front of the silver curve, where the nearest contracts start pulling interest toward delivery instead of pushing it away. What I'm about to reveal changes how the entire move makes sense, because the real panic isn't about yesterday's headline. It's about tomorrow's obligation. Welcome to Channel Name, where we decode what matters before it becomes a headline. Here we follow structure, incentives, and data, not noise. If you want analysis that explains the plumbing before everyone starts shouting about price, consider subscribing the way you'd keep the number of someone who always reads the room early, and tell me in the comments where you're watching from, because silver stress shows up differently depending on which market you live in. Now let's go forensic. In early February 2026, silver didn't simply trend down, it fractured into a sequence of shocks. The press framed it as a speculative unwind, a bubble deflating, a crowded trade snapping back. That can be part of the story. Volatility was high, and a high volatility environment punishes anyone who relied on call markets to stay solvent. But the abnormality wasn't just the red candles. The abnormality was that the market's internal behavior began flashing a different kind of stress at the exact moment the public assumed the stress was over. In a normal environment, when the front month becomes chaotic, traders reduce delivery exposure by rolling forward. The logic is simple. If you don't need the metal, you don't want to be anywhere near the delivery window, you shift to later months where liquidity is deeper, daily price moves are easier to tolerate, and the market feels less like a physical commodity and more like a financial instrument. That rolling behavior is what keeps the curve orderly. But around this window, commentary about positioning highlighted an unusual pattern. Open interest was not draining from the nearest months the way you would expect. It appeared to be growing. One snapshot described January open interest up by 1,531 contracts and February open interest up by 1,564 contracts. Numbers like that don't guarantee anything by themselves, but behavior like that matters, because it suggests participants were clustering close to the delivery zone during turbulence, not escaping it. Then came the detail that makes market veterans sit up. Instead of a clean forward roll from near months into later months, the flow was described as rolling backward, from a later contract into nearer ones, in the neighborhood of 2,195 contracts, shifting toward January and February, while March saw the opposite direction by roughly 2,136. Again, strategies differ, and not every contract represents a desperate buyer. But direction is information. When the crowd is pulling closer to the front end during volatility, it is a sign the market is valuing time. Think of it like a grocery store. If everyone trusts the trucks arriving next week, nobody fights over the last loaf today, they wait. But if people suspect the next shipment might be late, smaller, or allocated elsewhere, they crowd the shelf now, even if the price tag looks ugly. Backward rolling is the futures version of that crowding. It's not proof of a shortage, it's evidence of doubt. And that doubt matters, because silver's market structure is built on confidence that paper claims can be converted into real metal at the time and place the system requires. When that confidence weakens, a market can look liquid until suddenly it isn't. This is where the bullion bank angle enters, and it's important to describe it accurately. Bullion banks are not a secret club. They are intermediaries that connect miners, refiners, industrial users, investors, and exchanges. They make markets, provide financing, facilitate swaps and leasing, and often sit in the middle of hedging flows. Their function is to smooth volatility and keep price discovery moving. In quiet times, they look like stability. In stress times, they can look like the source of stress, even when they're reacting rather than initiating. But every shock absorber has a limit. The moment a market begins to value immediate delivery more than deferred promises, the intermediary's risk rises sharply. If a bullion bank has written paper exposure against inventory that is pledged, leased, or located in the wrong vault, the bank doesn't need to be wrong directionally to be under pressure. It just needs the timing to be wrong. This is not a new story. Silver has produced these rhymes before. In 2011, silver experienced a powerful run and then violent turbulence. The public explanation focused on speculation and leverage, but the deeper lesson was structural. When the physical base is relatively small compared with the size of paper exposure, small shifts in positioning can create outsized price moves. Result: rapid repricing, margin pressure, forced selling, and a reminder that liquidity can vanish faster than most models assume. In 2020, during the early pandemic shock, precious metals markets exposed another reality. Price quotes can diverge from physical availability when logistics break. Shipping disruptions, refinery bottlenecks, and location mismatches turned spreads and premiums into the real story. Result: the screen price became less important than whether you could actually source the metal you needed, in the form you needed, delivered where you needed. In 2021, silver became a recurring candidate for squeeze narratives. Many waves faded, but they left behind a consistent pattern. Whenever physical demand and delivery anxiety rise together, the market's front end behaves differently, even if the broader price doesn't immediately reflect it. Now in 2026, the rhyme isn't a carbon copy, but the fingerprint is familiar. Violent surface volatility, and underneath it, the front end pulling attention in a way that suggests the timing of metal matters more than the story being told about price. So who are the players moving pieces here? First, there's the exchange ecosystem and clearing system. Futures contracts concentrate leverage. A contract is not the metal itself. It's a standardized claim governed by rules, margin requirements, delivery procedures, and settlement timing. Clearinghouses care about volatility because volatility raises the chance someone can't pay. When volatility spikes, margins often rise. That is not drama, it is risk management. But margin changes have consequences. If margin rises quickly, traders who were comfortable yesterday can become forced sellers today. Forced selling can push price down even if underlying physical conditions are tight. That is how a squeeze risk can hide inside a falling market. The price drop relieves paper pressure for some players, but it can also intensify physical urgency if buyers interpret lower prices as an opportunity to secure near-term supply. Second, there are the bullion banks and market makers. These institutions quote two-way markets, warehouse inventory, run options books, and manage complex exposures across futures, forwards, and physical. When they sense rising near-term delivery risk, they adjust. They widen spreads. They reduce the size they quote. They prefer structures that are easier to hedge. They may even decide to step back from providing short exposure at the front end, because being short the nearest month when delivery preference rises is a different risk than being short, deferred month with time to maneuver. Third, there are industrial users. They don't treat silver as a trading idea. They treat it as an input. They care about continuity. They secure supply earlier. That behavior shows up as demand that is more urgent, more front-loaded, and more sensitive to delivery timing. Fourth, there are producers. Supply is not a tap you can open instantly. When a major producer guides to lower expected output for a coming year, it doesn't create an immediate shortage, but it does shape expectations. 7 million ounces in 2025. When a market is already edgy, a forward-looking supply revision can tighten psychology, especially among participants who need metal for operations. And fifth, there are inventories and vaults, which is where the paper versus physical tension often lives. Silver exists in specific places, under specific ownership structures. Some is allocated, some is unallocated, some is leased, some is pledged as collateral. A vault total can be large while the free float is small. A country can have metal, while the exchange delivery mechanism needs metal in a different form or location. Consider London. Published London Vault data showed 27,818 tons of silver at the end of December 2025. That's a massive headline number, and it's often used to argue that scarcity is impossible. But the market doesn't settle on a headline number, it settles on deliverability. The meaningful question is how much of that stock is actually available, unencumbered, and willing to move without creating stress elsewhere in the chain of claims. And to see why timing becomes the battlefield, you have to separate three different prices that get lumped together. There is the futures price, a leveraged benchmark for hedging and speculation. There is the wholesale physical price, which includes premiums for bar form and immediate availability. And there is the retail price, which includes fabrication and distribution risk. In quiet markets, those layers track each other closely enough that nobody argues about the difference. When those layers separate, the relationship between paper and physical becomes unstable. A participant short futures as a hedge expects to source physical smoothly. But if the physical market tightens, the hedge can behave badly. The futures short is still real, while the physical offset becomes expensive or slow. That's when hedges turn into risks. This is also where geography matters. It is specific bars and specific vaults under specific jurisdictions. Metal in London is not automatically the same as metal eligible for delivery elsewhere without time, paperwork, transport, and sometimes refabrication. During calm periods, those frictions are background noise. During stressed periods, frictions become costs, and costs become spreads, and spreads become pressure. So bullion bank panic is better understood as intermediary risk compression. Banks that intermediate this market are paid to take small, steady risks. They are not paid to take large, unpredictable timing risks when volatility is extreme and near-term demand is crowding forward. When risk compresses, they defend liquidity. They hold more cash. They tighten credit. They reduce the metal they are willing to treat as freely available. That selectivity can be visible. It can show up as wider bid-ask spreads, more expensive protection, and a reluctance to quote size in the nearest month. Now consider the real economy side that gets ignored. Industrial buyers don't live on charts. They live on calendars. They have delivery schedules, production cycles, and penalties for missing inputs. When volatility spikes, many become more conservative. If they were comfortable running lean inventories, they may decide to hold more. If they plan to wait for later shipments, they may pull orders forward. That behavior is rational, and it is exactly the kind of behavior that pulls on the front end. At the same time, speculative participants can be forced out by margin calls, creating a paradox. The market becomes less crowded on paper at the exact moment the physical chain becomes more cautious. The paper cleansing can look like relief, while the physical tightening can look like stress, and both can happen together. If price is falling because someone is forced to sell, that tells you about leverage. If the front end is tightening because someone is choosing near-term exposure, that tells you about delivery preference. When forced selling and delivery preference rise together, the system becomes unstable because it is being pulled in two directions. And this is where the classic silver problem returns. The paper layer is enormous relative to the physical layer that can move quickly. Most days netting makes that invisible, positions offset, payments clear, and only a fraction ever approaches delivery. On stress days, confidence becomes the asset. If enough participants decide that netting is not enough and timing matters, the system has to respond. Sometimes the response is quiet, like inventory being mobilized from one vault to another. Sometimes it is mechanical, like margins rising and credit tightening. Sometimes it is visible in spreads that refuse to normalize because the market is charging for immediacy. The key point is that the response is always about time. The closer the obligation, the fewer the escape valves. That is why front-end behavior is such a powerful tell. It reveals when participants start treating silver like a physical commodity with constraints, not a screen price you can roll forever. When that happens, small shocks can cascade through linked contracts very fast. This is where dislocation becomes visible. On one side, the screen can show a brutal sell-off, implying rejection. On the other side, the front-end behavior can show urgency, implying a preference for immediacy. Two signals pointing in opposite directions. This is not an abstract concept. It shows up as spreads that refuse to normalize, as volatility that stays elevated, and as open interest behavior that keeps clustering where you would expect it to drain. When that cluster forms, the system begins to test itself, because the nearer the contract, the less time there is to solve a supply problem with paperwork. So let's define the one signal clearly. The one signal is front-end stress, visible through abnormal roll behavior and nearby contract crowding during volatility. In plain language, it is the market choosing now over later. At the same time, the market is supposed to be de-risking. If the market were truly relaxed about supply, the front month would be avoided. If the market were truly flooded with metal, the front end would not behave like time is scarce. When it does, it's a warning that settlement mechanics may matter more than opinions. Now, to be precise, a short squeeze is not guaranteed by this signal. Silver is complex. There are many participants. There are many hedges. Some shorts are legitimate hedging flows. Some are market making. Some are spread structures designed to capture financing differences. But squeeze risk rises when two conditions converge: increased preference for near-term delivery and a reduced willingness of liquidity providers to supply paper shorts at the front. Here is how that mechanism can play out without any melodrama. Step 1. Volatility rises. Volatility raises margin costs and increases the probability of forced selling. Step 3. Physical-oriented demand sees lower prices and uncertain logistics and begins to secure exposure sooner, not later. Step 4. Nearby open interest grows or stays sticky because participants choose the months where delivery risk is concentrated. Step 5. Market makers and intermediaries reduce their willingness to be short the nearest month. because the cost of being wrong on timing has risen. Step 6. Spreads and rolls distort, and the front end tightens further, not because anyone declared a shortage, but because the system is being tested at the edge of its timing. This is why a bullion bank can appear panicked during a sell-off. The bank may not be panicked about price direction. It may be focused on the plumbing. It may be focused on whether it can source metal of the right form in the right location quickly, enough to meet obligations, while also meeting cash margin calls and maintaining hedges. And this is where contradictions among experts become understandable. Both camps may be seeing real pieces of the puzzle. The difference is which layer they are watching. This is the part most people miss. A falling price does not automatically mean easing. In leveraged markets, a falling price can be the symptom of forced liquidation, while the underlying supply chain remains tight. When those two forces collide, the market can behave violently in both directions, because the paper layer and the physical layer are responding to different pressures. So what does the data suggest going forward based on history, without turning this into a prediction? Historically, when front-end stress persists alongside elevated volatility, the market tends to search for a resolution through one of a few pathways. One pathway is normalization. Inventories are mobilized, logistics improve, and participants regain confidence in deferred supply. In that pathway, the front-end crowding fades, rolls behave normally again, and volatility declines. The story ends quietly. A second pathway is oscillation. The market stays choppy with sharp downdrafts followed by sharp recoveries because liquidity is thinner than usual and participants become tactical. In that pathway, every dip becomes a test of whether nearby demand returns, and every rally becomes a test of whether liquidity providers reappear. A third pathway is a repricing event. That could take the form of a sudden spread blowout, an abrupt shift in delivery behavior, or an exchange level response that changes incentives quickly. In that pathway, the market is forced to reconcile paper exposure with physical constraints under time pressure, and the reconciliation can be fast. Notice what drives the distinction. It isn't a single headline. It's whether the market continues to value immediacy. The more the system values now, the more fragile it becomes. So if you want to understand the divide that forms in moments like this, it's not between optimists and pessimists. It's between people who watch the headline price and people who watch the settlement layer. Most participants see silver after the move. They notice it once it's already trending on their feed. Institutions watch it before because they monitor spreads, rolls, and the behavior of the nearest delivery months. They understand that the market can look calm until the very moment it can't. That's the information gap. And the information gap becomes a wealth gap over time because the first move belongs to the participants who see the mechanical stress early, while the last move belongs to the participants who only see the outcome. If there is a single takeaway from this entire episode, it's that silver's most important story is often hidden from the loudest part of the chart. The story lives in the curve, in the delivery timing, and in the willingness of intermediaries to provide paper supply at the front end. Now, the question isn't whether silver can be volatile. It already proved it can be. The question is whether the market's machinery is signaling a deeper dislocation that demands resolution. This is channel name, where we decode what matters before it's a headline. If this connected dots you hadn't seen, you know what to do. And keep this in mind the next time the screen flashes red or green. The market isn't das, only asking what silver is worth. It's asking whether silver can be delivered on time when it counts.